If we lost the dollar as the world currency, I think that would be the equivalent of losing a war. Those words echo like a warning shot. And today, that war may already be underway. Not with missiles or troops, but with money, influence, and power. Brace yourselves. The global economy is shifting beneath our feet, and America's grip on financial supremacy is slipping. Donald Trump's worst nightmare is unfolding in real time. The U.S. dollar, the cornerstone of American global dominance, is being abandoned. And at the center of this unraveling, China. Beijing's no longer playing nice. After years of taking hits, chip bans, tech blacklists, tariffs, and loan freezes, China is punching back. But this isn't retaliation. It's a surgical strike on America's financial foundation. Let's break down how the U.S. is trying to contain China, and how that very strategy may be accelerating the fall of the dollar. A war over labels, developing or dominant. For decades, China held a unique status. Despite becoming an economic juggernaut, it was still classified as a developing country by global financial institutions like the World Bank, United Nations, and Asian Development Bank. That label wasn't just symbolic, it came with major perks: low interest loans, extended repayment periods, and trade advantages. To critics in Washington, it looked like a loophole. Why should the world's second largest economy still get discounts meant for struggling nations? The U.S. is trying to shut that door fast. In 2023, a law was revived called the PRC Is Not a Developing Country Act. Its mission? Strip China of its developing status across every major global institution. Treasury Secretary Scott Bessent has been leading the charge, pressuring the Asian Development Bank and others to end loan programs to China. The rationale: China is too wealthy, too powerful, and too advanced to qualify for support. But here's the twist. While Washington insists China is too rich for aid, China still has an average per capita income of just $16,000 compared to $82,700 in the U.S. That means millions of Chinese citizens are still living in poverty. The U.S. selectively ignores this when it's politically convenient. And while America cries foul over China's global financing, it also owes China over $750 billion in debt. So, who's really benefiting? The global lending war, this battle, isn't just about who gets cheap loans. It's about who gets to shape the future. The World Bank and IMF, the two titans of global finance, are increasingly caught in the middle of U.S.-China tensions. Officially, they're supposed to help countries in need. But now, Washington wants them to help advance American interests too. At a recent summit, Scott Bessent warned these institutions that if they continue treating China like a developing country, they could lose U.S. support. That's not a small threat. The U.S. is one of their largest funders. But Bessent wasn't alone in his message. Shortly after, President Trump doubled down. He warned that any country siding with China or with the BRICS alliance would face massive tariffs. And with his track record of global tariff wars, this isn't just bluster. It's a promise. But Trump's constant flip-flopping, one day announcing new tariffs, the next day walking them back, is causing chaos. Global investors are nervous. Businesses don't know how to plan. The result? Trade uncertainty, market instability, and a growing sense that America can no longer be trusted to lead. And this trust deficit could be the final nail in the dollar's coffin. China's parallel system. While Washington tries to pull strings and punish dissent, China is building something else entirely. A parallel world order. Beijing knows that U.S. dominance relies on one thing: the centrality of the dollar. So, China is methodically creating alternatives. Let's start with the currency war. China has been aggressively pushing the yuan as a global trade currency. As of mid-2025, nearly 40% of cross-border transactions in China are now settled in yuan. That's huge. It allows Beijing to sidestep U.S. sanctions, attract global partners, and reduce reliance on the dollar. Goldman Sachs estimates that even a 1% increase in yuan usage could drive a 3% boost in Chinese stock markets. For foreign investors, it's becoming more appealing to trade in yuan than in dollars. At the same time, China's massive Belt and Road Initiative continues to expand. In 2025 alone, over 145 countries are participating in Chinese-funded infrastructure deals. Roads, ports, railways built not with Western loans, but with Chinese capital. The U.S. calls this debt trap diplomacy. But many countries disagree. Western banks won't touch risky infrastructure projects. China will. And that's earning Beijing loyalty in Africa, Latin America, Southeast Asia, and the Middle East. Take Qatar, for example. The Qatar Investment Authority just bought a 10% stake in a Chinese finance giant. That's not just an investment. That's a vote of confidence in China's economic future. Industrial war, EVs, AI, and the race for tech supremacy. The battle isn't just over money, it's over machines too. From electric vehicles to advanced AI, China is racing ahead. In 2025, Chinese automaker BYD is slashing EV prices by 10% to 30%, stealing market share from Tesla in Europe, Southeast Asia, and beyond. This is more than just a commercial competition, it's strategic. China wants to dominate future tech, and the U.S. knows it. In response, Washington has unleashed a barrage of export controls targeting AI chips, semiconductors, drone technology, and more. The goal: choke China's high-tech growth. But Beijing isn't backing down. New factories are rising, and Chinese firms are rapidly developing domestic alternatives. The message is clear. China doesn't need to play by American rules anymore. It's writing its own. Why the dollar is in danger? Let's be clear. The U.S. dollar remains the dominant global currency used in 88% of all international transactions, and backing over $4 trillion in global trade. But dominance is fragile. If more countries choose to trade in yuan, euros, or local currencies, that demand for the dollar starts to erode. And when fewer countries hold dollars in reserve, the U.S. loses a key advantage: the ability to print money cheaply and finance its massive debts. Already, global central banks are reducing their dollar reserves. Russia and China have aggressively de-dollarized their trade. Even U.S. allies like India and Brazil are experimenting with alternative currencies. And this trend is accelerating, not because countries want to abandon America, but because America is giving them every reason to. Washington's heavy-handed tactics, endless sanctions, unpredictable tariffs, and aggressive diplomacy are pushing the world to look for options. And those options increasingly lead to Beijing. The real question: so what does all this mean? The U.S. believes that by cutting China off from loans, markets, and institutions, it can contain Beijing's rise. But China doesn't need to play defense. It's playing offense, restructuring global finance, deepening partnerships, building infrastructure, and expanding trade in its own currency. This isn't just a shift in economics. It's a shift in power. The real question isn't whether China can survive American pressure. The question is, can America survive China's rise? Subscribe to stay ahead as the global power balance flips ***.